Well, hi there, and welcome back to another episode of Let's Talk Real Estate Investing. I'm your host, Sharon Vornholt, and I'm so happy you're tuning in today. My guests today are creative financing experts, Mel and Dave Dupis. Mel and Dave have over 20 years of combined experience, and they have bought over 400 units with no money and no JV partners. So I think it's safe to say they are definitely the creative financing experts. As you know, one of the biggest problems that real estate investors everywhere have is funding their deals. And even if you have a relationship with a bank, a small bank, or a portfolio lender, there will come a day when you'll get cut off and you'll need to look for other types of financing. Ask me how I know that one. That might be a private money lender, but it could also be some other type of creative finance. And that's what we're going to talk about today. Buying property, creative financing, and how to invest none of your own money as you go about this. So welcome to the show, Mel and Dave.
Thanks so
Hey,
much, Sharon. Great to meet you.
yeah, thanks for having us on, Sharon. Appreciate that.
Oh, I'm sure it's going to be fun. Tell me a little bit about your backstory and what made you focus on creative finance.
Yes, well, when I met Dave, I had two properties. He had the one, and we were slowly buying properties the traditional way, working all the time, trying to save up for the down payment and buying a property and then waiting a long period and whatnot. But as most of us at some point it's going to happen, we run out of money. We just couldn't grow as quickly as we wanted to. We both wanted to quit our full-time jobs and have more freedom in our lives. And we were actually on a trip in Florida and I listened to Rich Dad Poor Dad by Robert Kiyosaki, and it changed our mindset completely about we're doing it all wrong. Dave was a full-time firefighter, working two part-time jobs as well. I was working full-time and also had two part-time jobs. We were literally trading our time for money. And although the book didn't show us how to do it, it made us realize that we're doing it all wrong and that there's an easier way to do this. So we got to work. We started interviewing those who were successful in the creative financing world and those who also failed. We put a plan together, and the next year we were able to buy 12 properties in less than 12 months. That was 56 units. And the way we do it without joint venture partners. So we keep the equity and decision making just between the two of us.
That's awesome. So let me, did I hear you say that you were both firefighters or?
No, Dave was a firefighter. I was working full-time at our local college.
Okay. Okay. You got me with that one. So that one. Okay. So that is pretty awesome that you've never used JV partners. Let me ask you this. From what I understand, you have a large portfolio that's a mix of all different types of residential and commercial properties. Is that the case?
Yeah, mostly multifamily. We do have some mixed use with some commercial on the bottom and residential up top, but our bread and butter, our main thing is the multifamily space. Yeah.
Did you all have single family at all, or a small multifamily like duplexes, triplexes?
I love that you asked that, Sharon. And yes, we literally were able, because people are always asking, should I just go for big buildings and is bigger better when it comes to multifamily? We were able to actually leave our full-time jobs with duplexes and triplexes. So it doesn't necessarily need to be these massive buildings to be able to walk away, but we still have a single family home in our portfolio. Actually, we're just purchasing another single family home in Ohio right now. It just depends on the deal. We're looking at 40 plexes. Our biggest building as of right now is a 50 plex. So we're multifamily, as long as it makes money, and time versus effort versus reward is kind of our how we look at things. So we've got all sorts of different multifamily in our portfolio.
That is so interesting because I think people often think once you go down the multifamily path, there's no going back. And what I see a lot of times is people selling off their single family homes, even if they're profitable. They sell them off, or as they move into different classes of assets, they decide they have to be all in or on one. So do you have a favorite? So is your favorite large multifamilies, or is it something else?
I guess it's funner, let's say. It's funner, and maybe it's ego, and to look at those bigger buildings and have more doors, but they still have to make sense. And this, they still have to underwrite accordingly. And because we are using other people's money in creative financing, Mel and I say it all the time. We have to exit the deal before we enter. So we have to know how
Right.
we're going to pay people. Yeah. So that's the
Right.
main thing we do. Now, the thing is, it also depends on the investor. So we'll have people that come to us with funds, and some people will say, I trust you. I know you're going to look at some deals. However, my comfort level right now is 4 units and under. So if you're going to use my funds, I only want to, because I can only imagine myself investing in a duplex or triplex. So instead of turning away those investors and saying, no, I won't take your money or I won't use your funds, we just find duplexes and triplexes or whatever type of asset class they're into, and we make it work within our model. So I think that's been our secret sauce is we're not afraid to look at any type of deal as long as there's an exit strategy and it makes sense.
Okay. So to be clear, are you using the money for short-term money or long-term money or both?
Well, not overly short. So typically it's maybe a 2-year, 5-year term overall.
Okay.
Because we're not flippers, we are buy and hold overall, although of course sometimes we do sell them and put them into another investment. So typically it's at least a year, but somewhere between 2 and 5 traditionally.
Okay. Well, that's an interesting point because oftentimes the money is for a year or for what I consider even a year is kind of short-term financing, maybe more of a rehab fix and flip situation. So you would, just to be, so the listeners are clear on this, you would use this money for however many years, 3 to 5 years, and then you refi out. Is that the traditional thing that you do?
Yeah, and it'll depend. So, for example, let's say if we're using seller financing, which is our absolute favorite,
Mhm.
so carrybacks or seller financing or VTB, everyone calls it something different, but it means the same thing. So
Mhm.
that one will typically be whatever the seller's looking for, as long as we can make sense of it. And we usually see between 1 and 5 years on those. If we're using registered funds, so self-directed, then typically those are more long-term as well. No one, well, from our experience, once they've interviewed you, they've seen the deal, they typically don't want just a 1 year term because they want to set and forget and just get those interest payments going back in. But the promissory notes, yeah, you're bang on, Sharon, those ones are typically shorter term, a year to 2 years max. They want to rinse and repeat their money over and over.
I think that's what I have found that people want. They want to the rinse and repeat because a lot of the private money lenders that I know, they charge points. They charge, their interest rate, but their points. And especially if they're retirement age, let's say, they're looking to make their money last a long time. So, but I think this is an important point that there are many ways to do this, and how you structure these deals kind of depends on what your seller's willing to do and what your private money lender's willing to do. So I would say that you have to get really good at having conversations. Would you agree with that?
Yeah, absolutely. Every deal looks different based on their needs. So we love asking a lot of questions, listening very attentively, and structuring the deal around that to really make it a win-win. Because if somebody's going to lend you money, especially if it's owner financing, well, they might have a reason. They may want to close at a certain time of the year, or they may need a certain amount of interest, or they may want to keep a certain like there's different reasons why people or think they need as part of the transaction. So really making it a win-win.
I would think this would be a particularly good time for owner financing with interest rates so high at the bank. Am I correct in assuming that?
Yeah, yeah.
So tell me about that. If I were to go to someone that had a multifamily property for sale, and in their mind, maybe they're thinking they're going to get cash, and you propose seller financing and that they could make interest, how would that conversation start with them to maybe change their expectations?
Yeah, well, it's really seeing if they're even open to creative financing or if they even know what creative financing is. And sometimes you will get a hard no, absolutely not. I need my money. I don't believe in that. And they just don't even want to hear about it. And that's okay. It's just not a good fit for them. Sometimes they'll say, what is that? What do you mean, Mel, Dave? And then we have to explain it. And sometimes they already understand what it is. And they're like, well, I'm not sure. And then that's where negotiating properly and really making it a win-win is important. And essentially, why would somebody want to do this? Because it benefits them. That's why people do owner financing.
Yeah.
Even Dave and I, we hold financing on 4 different buildings that we've sold. We don't know those people, but we did it because it benefited us financially for capital gains. interest, we got the purchase price we wanted, we got the date that we wanted for closing. So that's why we were willing to do it. So if you're able to structure the deal accordingly, and you're still making money, and you have that exit strategy where you can confidently pay people back, and this of course needs to be numerical, then that's when you can show people. And that's what we use our matrix, where we can physically show people how we're going to pay them back, because most people who say no, it might not be that they don't want to, it's just that maybe that trust issue. Well, how do I know you're going to pay me back, right? So it's important to show them.
Then maybe they don't understand. And you bring up a good point that I think anyone who's been in this business a long time assumes that everyone knows, but they don't really know. And that is, you have to have your exit strategy or strategies, maybe a plan A and even a plan B, the day you buy the property, because you're so right. Your credibility, your reputation, your entire business hinges on you keeping your word. And in this case, it means paying the investors back, paying those people back the way that you said you would pay them back. Or if you run into a glitch and you have built this reputation, you can have a conversation with them and say, hey, my money's hung up for 2 months, 3 months, whatever. But then they're more reasonable because they trust you. You have a history with them. But you've got to know what you're going to do the day you buy the property.
I couldn't agree more. And it's funny, Mel and I, and you talked about reputation. Mel and I just spoke at an event this past weekend with Barbara Carcaron from, I always forget if it's Dragon's Den or Shark's Den. Yeah.
Sorry, yeah.
Yeah, but she was just saying that same thing. Is she's 75 years old, and her number one point or advice was reputation. And anything that you do, like you're saying, Sharon, was be honest and transparent. Don't lie to your investors. If there is something going on, and like you said, you have a hiccup, you need an extra 2-3 months, be honest with them, because they'll never say, hey, you lied to us. At least it was, my money's hung up, I need 2-3 extra months. They'll understand that a lot more than trying to, what's that, pull the wool, or whatever that's saying, pull the wool over their eyes. So
do that. Give them a little incentive, a little bonus at the end for helping you out if you need to extend it.
And in all reality, people that are in the position to have enough money to loan to you, they're smart people. I mean, they can understand you have a hiccup. They will never understand or be okay if you just flat out put them off, delay, don't keep your word. But in this business, it's true in any business, but in real estate investing, where oftentimes people have been taken advantage of, your reputation is literally everything in this business.
I agree. And Mel and I, when we first started doing this, that's why we did our research. We interviewed, we analyzed a lot of people who built a portfolio and lost it. And we wanted to see, what is that reoccurring theme? Like, what are they doing that we don't want to go down that path? And it just kept coming back to their exit strategy. So when we were analyzing deals, we said, this has to be at the forefront. We have to understand how to pay people back. And we always had the model in our minds of literally our reputation and our assets, the golden goose. If ever something happens, we'll sell our house before we don't pay back an investor, because we can always buy a house, but we can never buy back our reputation. So we've always kind of got into that model, and hey, I don't want to sell my house, so let's make sure this deal makes sense.
Yeah, 100%. But I love your attitude, because that's the attitude you have to have I always tell people, you're playing the long game. Don't think about the inconvenience it causes you today or for this month or maybe even this year if you have to sell your house, but play the long game. And if you do the right thing, I just don't think you can lose in this business. You just have to do the right thing. Keep your word 100% of the time.
And don't be afraid to walk away from a deal. If you thought you found the perfect deal and it cash flows and it's in a great area, and then you do your calculations and you're like, oh, my exit strategy, I love everything else, but my exit strategy is a little weak. Don't buy the deal. We have, and I know it's exciting, and hey, owner financing and everything seems right. And we've had these deals as well, where it's like, okay, I love everything about the building. There was owner financing involved, but I don't have a clear exit strategy. So of course I have to turn down the deal, because I'm in this for the long run as an investor.
Exactly. Some of your best deals you'll ever do are the ones you don't get ultimately.
Right. Well, I love that.
Yeah. So there is that. And I think to your point, when you walk away from a deal, sometimes it really is the best thing that could happen is that you walk away. Now, a lot of people are sitting on the sidelines now. Interest rates are going up, and I'm old enough to look back and go, my very first house I ever bought was over 7%. That was the norm at that time. And then everybody got really spoiled with low interest rates. But I have a friend who's well, he's a real estate investing friend, and I don't know how it is, maybe 80-ish. And he always says, I've made money when interest rates were 3%. I've made money when interest rates were 18%. I just did it differently. And that's his philosophy. If you can think outside the box, you can be creative, you can make money in any real estate market. And I think that's true today. Wouldn't you agree?
I love that. And what words of wisdom. It's real estate. You're playing the long game. You just need to pivot sometimes. For example, we're closing a deal in Ohio and we're closing a deal in Orlando the next couple of weeks. We're just waiting on some EIN numbers. Anyway, long story short is I believe the one in Orlando is 8.25 or 8.5% interest, and the one in Ohio is 9% interest. We are still cash flowing on those deals. So we're still able to make money. And hopefully a year from now, 2 years, again, no one has a what do you call it? Crystal ball. Or, no one can predict, but assuming hopefully they do go down, we're just going to continue to cash flow even more. But we'll never stop buying real estate. I agree with your friend. We'll just keep pivoting and making money and continue acquisitions. It's time in the market, right? Not timing.
It's the monthly income that we're making, but also it's the appreciation that we're getting over time from buying. Some people try to time the market, but what they're missing out on is this continuous growth that happens over years and years and years. So I was buying 5 years ago, I'm buying 2 years ago, or buying today, and I'm going to keep buying next year as well. Because it's the cash flow, of course, but it's also the appreciation that you naturally get over time as well. And especially if you find properties where you can force the appreciation and get that natural lift, or that forced lift, that makes it even more profitable.
True, so true. Now, some people, I'm assuming something here. Again, we're talking about other people's money, and there may be some people listening to this that aren't really clear on how that works. So let's talk about some ways to use other people's money. We touched on seller financing, but what are some other creative finance strategies that you all have in your toolbox?
So we love using registered funds, self-directing and utilize them in the form of mortgages. And people get the people get spooked with that. It's above board, it's legal, the attorneys and that take care of everything for you. The really cool thing is we've got contacts. So for example, I'll talk about Canada and the US. So you can use other people's as well, but you can use your own. So for example, if you're a Canadian with registered funds such as RSPs, you can actually use your own to buy in the US or Costa Rica. Or if you are a US citizen with your own 401k or Roth IRA, you can actually use your own to buy, let's say, in Costa Rica or Mexico. So there's a lot of cool ways to use other people's and your own. You can't necessarily use them to buy your own real estate. But and then promissory notes is what we love doing as well, which is basically a contractual agreement between two parties. We use that for deposits, down payments, renovations, closing costs. So that the promissory note is a beautiful thing as well.
It just provides a lot of flexibility.
And most recently, again, Mel and I won't pretend to be the sub 2 experts, but we are negotiating some deals in Texas with sub 2. So again, until it closes, we won't really talk too much about it, but it's something that we are exploring.
Well, that's definitely an avenue that a lot of people can go down. It's maybe more attractive today with, in one way to look at it is there are a lot less properties on the market, but there are still some sellers out there willing to sell sub 2. There's no doubt about it. So that's a strategy. Once again, you have to be very careful with that. You have to not leave the seller in the lurch if something goes sideways. But it's a very valid strategy. And I personally know people that is their strategy. That's the one thing that they do. Like your creative finance experts, they are niched down even further and they're sub 2 experts. So let's talk a little bit about scaling. You all have scaled up very fast, and people are probably going, "Okay, Mel and Dave, I just don't understand how y'all did that." So let's talk about that. And another thing to note, they're in Canada and they are investing here in the U.S. and other countries. So do tell everybody just how you did that.
Well, I mean, not gonna lie, it's gonna start with mindset. To start off, realizing that that I can do it, even though I didn't know quite how to do it at the beginning. So setting myself or ourselves some strong goals, basing it around our why, and then of course, then it's action time as well. And when I'll take the 12 and 12 for example, that year we're still working full time, so we were very busy. We have 3 kids. So it was just really scheduling accordingly. And we didn't want to take anything away from the kids, of course. So we would just get up. We're morning people. So we'd just get up really early in the morning. And that would be our time in the mornings before the kids would get up. We'd have that hour and a half or so, get up at 5, where we can really concentrate on building our portfolio, and doing that hour and a half every day consistently over a long period of time was very cumulative. So just setting a time, some time, and stopping to watch TV. So once the kids went to bed, we went to bed as well, so we can get up and do it all over again. So putting time aside to me, we chose to make it a priority, which was amazing. The next year I was able to quit my full-time job, as well as we continue to grow after these properties, and now we're in different countries and doing all these great things, is realizing that we can't do it alone as well. So although we don't have joint venture partners, we do have an amazing team behind us, whether it's property management, whether it's cleaners, whether it's my social media team or my marketing team or my finance department. So we have a lot of people behind us as well, that kind of came naturally as we grew as well. And that's something important as well, because you will get, as you grow, probably to a point where you can't grow anymore because you're running out of hours. And that's not why we got into this. We wanted to create more time, more flexibility. So as soon as we were able, I remember that's literally how we would get ourselves motivated. Like, okay, if I buy that building, I'm going to hire my first cleaner, so I don't have to clean anymore, right? So it was just really structuring accordingly, so I would create more and more time for myself.
I love that you put that all together like that. You cannot do it alone. You have to start adding team members in. I think the first hire or two that you make are quite terrifying, because oftentimes you really don't know what you're doing. It's a little bit of a give and take, getting the right person. I think everybody's done that wrong, but you just have to do it anyway. I think it's kind of like rearing children. You're going to make mistakes, and then you just pivot and say, okay, number 2 is going to be easier than child number 1. So
I'm gonna learn from this and this. Yes.
Yeah, it's getting harder.
Yeah, kind of like that. By the time the 3rd one comes along, okay, yeah, I know you're here. Yeah. But I think you talk to time management, which is so important. Getting up before the kids. I think when you have small children, that is crucial. You've got to find the time. And maybe somebody is a nighttime person. Maybe their time is after the kids. I used to tell people, I still tell them when we talk about marketing, you have to find the time. You have to, if you don't have leads coming in the door, whatever your strategy is, you are not going to be in business very long. So you have to find the time for the things that are really important to your business and to grow your business. So I commend you on doing just that.
Yeah, and something else as well, because we are a couple doing this together. After a while, although at the beginning we were pretty much doing most of it ourselves together, then it came to, after a while, we got to know each other's strengths and weaknesses, and dividing and conquering as well, but based on tasks and what we love and whatnot, and that helped create extra time for ourselves, of course, as well.
Right. I also love that you say you didn't have joint venture partners. Was that, I'm sure that was by design. You just wanted to build your portfolio and have it to be yours.
Yeah, we just really wanted something where we're the sole decision makers. We keep all the cash flow, we keep the appreciation. If someday the kids want to take over the portfolio, they can, or if we decide to sell it, we can. We just have a lot of flexibility, and it's only between us as a couple.
Yeah, I love that. I'm kind of a control freak that way too. So let's just face it, that's kind of what it
It
is.
kind of came down to that, right?
Let's be real.
I
Yeah.
want
Right,
control
right.
over my assets. Yeah.
I love marketing and I especially love off market deals. So that's where I've always worked off market deals and I've specialized in probate. So I'd like to talk about how you all find your deals and where you find these hidden gems, these off market deals, or as you call them, cash cows. So in your world, where do you find those?
One of the things I love speaking with property managers in the areas that we're looking at. So, for example, once we identify a market that is, we typically like tertiary, secondary markets where we see that there's still strong, well, higher cap rates, strong cash flow. We'll start basically finding our investor focused real estate agents and our investor focused property managers. And then we'll start having conversations with them, giving them the I guess the buy box that we're looking for in regards to the asset type and possibly seller financing. And then they'll typically have some pocket deals, or the PMs, the property managers will know, hey, you know what? This seller had told me that they've been thinking about it for a while. If ever someone approaches them, so that's a really low hanging fruit for a lot of people, is approaching, just reverse engineer. These are the people that literally talk to owners all day, every day, because they're managing their assets. So that's a really easy one that we've always been I don't want to say lucky with, but that we've had great success with.
That's with
For your listeners, that's a very easy one. Contact some PMs, establish some rapport, especially if you're going to be using them in that area, because it's a win-win. If you have a conversation with them, I'm going to be investing in this area. I will need a property manager. Do you have anyone that's looking at selling? And reassure them, if they do end up selling it to me, I'm going to be using your services. Because at the end of the day, they're just thinking, I'm losing a client. I'm losing that monthly cash flow. This is going to affect my bottom dollar. But if I can help this guy or this person buy, I won't lose that. I won't lose that asset. It'll still remain in my portfolio. So that's why they end up helping us, is making it a win-win.
And I'm much like you, Sharon. I love marketing. I love social media. So that's definitely helped us as well. Is once people realize that what we do, and when we started getting in front of people and just letting people know that we're looking for deals and spreading the word. And I was telling everybody, I was telling strangers, hey, if you happen to hear about any properties for sale, and I just got in that habit of telling people, and it was amazing how many deals people started calling us. Like, it was amazing how many deals we would get on our desks, and it became a quantity, which was fantastic. So then I could really get granular and analyze the deals and really choose the ones that were strong and cash flowed and have the exit.
That's so true. I tell people, I really believe that networking is the most underrated marketing strategy on the planet, because you talk about talking to people, telling everyone what you do. People will come back to you 5 years from now or longer and say, I remember that you said this, but they remember you because of your online presence, because of your in-person presence. We're all back to marketing. We're back to content creation. We're back to, you mentioned Instagram. All of these things build your brand and they build your credibility. And that's what makes people remember you. Sure, someone could remember you and you not have any of those, but the odds are so much higher that you become the go-to expert by simply understanding some basic marketing principles. But I love networking.
I agree.
Yeah. Let me ask you this. You mentioned, Dave, about finding real estate specific or investor specific realtors. Now, I know within my city, within my RIA group, real estate investing group, for those who might not know that term, I know who those people are. But if you're going into, let's say, Orlando, and it's your first property, you don't know anyone there. How do you know if they are an investor focused real estate agent, or if they just think they are? Because that's two entirely different things.
Completely.
Yeah, I love that. So if I'm breaking into a new market and I have zero contacts, and I say when we're breaking into new markets or we have zero contacts, couple of different things. I'll go literally on the MLS and I'll look at income properties, some multifamily properties. Who are people that I see reoccurring coming up? You can narrow it down that way. But again, you'll still have to have a conversation with them, but you could see who's doing a lot of real estate transactions in this area, which doesn't mean that they are investor focused, but at least you start to see who the players are. and then having the conversation with them, seeing, hey, are you guys open? Are any of your clients or any of your sellers open to creative financing? I've had people just hang up on it, like, no, that's illegal here, and hang up. It's like,
I'll never represent you. I'm like, all right, well, we're not doing business together.
you get on, not on
Yeah.
our list anymore.
Well, I think that conversation piece is really
It's
important. Is just quizzing them. So what do you think about this? And if I say that I'm interested in a vendor take back for the client, how would you approach the client to for this opportunity or for this deal, and just pay attention to what they're saying, and are they hitting things that I'm looking for, or is there some negativity attached to it? Because sometimes there definitely is, or they just you'll notice they just don't have the experience with it as well. So if they don't understand it, it's going to be really hard for them to be your advocate as well.
That is such an important thing, because in my area, we do, here's a case in point, we do a lot of double closings, especially wholesalers. They'll do double closings. And I remember an instance when I had a probate property that I was wholesaling this particular property, and the probate attorney told me it was illegal to double close. Well, it's definitely not in the state of Kentucky and most other places, but you can, if you have a conversation with these people, to your point, you can kind of vet them without ever saying anything, kind of off the track, or whatever you would want to say. You can simply just ask questions and get your answer. That's a great point.
Yeah, exactly. Like, if you're an investor focused agent in an area, there's just numbers that you should know, right? If I call you from anywhere and say, what are the cap rates? What's the range of cap rates in your area? What are the market rents that you're seeing for this type of unit? What is the price per door? Like, these are things that should just be coming off the tip of your tongue, because you live it and breathe it every single day and you're dealing with investors. So typically I'll ask those very simple 3 questions, and if they don't know it, it's nothing against them either. It's nothing wrong. It's just, I know that they don't deal with investors on a daily basis.
Now, did you have much success with owner financing, seller financing with single family homes?
Yeah, it's like, for example, what's the most recent one? The one in Ohio is not seller financing. I guess the most recent one that we've done, Costa Rica.
Costa Rica, yeah.
Costa Rica, or casa, not a house, it's a casa in Costa Rica, but
it sounds fancy, yeah.
Sounds fancier, yeah. But the most recent one, we actually sold it in May or June of this year. So it was a 1-year seller financing deal, just like we do in Canada and the US. The owner was he was from
Switzerland,
Sweden or Switzerland. We never met him.
Switzerland? Oh, my word.
Yeah, Sweden or Switzerland, I forget now. Everything was negotiated through the investor-focused real estate agent. They held a first mortgage for us, just like I think it was about 80 to 85% of the purchase price.
Yeah, we just promissory note for closing costs.
Yeah. So he's down payment sorry, go ahead.
As I was going to say, so you did not put any money in the deal?
No, off the top of my head, I think we bought it for, I think it was $325. We had a $200,000 mortgage. We borrowed, I forget the numbers. We have it on but basically, yeah, borrowed a promissory note. We did the renovation. It was a BRRRR project. It was a BRRRR project from our city, North Bay, Ontario, Canada, right? Through Wi-Fi, or through the laptop. And we ended up making $104,000 on that in a year. Just quarterbacking it from Canada.
It's more than I used to make, right? It's more than you used to make as a firefighter. That's the power of creative financing. None of our own money into it, all from our laptops. And we actually went vacationing, and we went and checked it out and stayed there as well for a couple of nights. The rest of the nights we stayed at our other place. But that's the power of it, is that once you know how to use these creative financing strategies, if you're looking to diversify your portfolio in different countries, we love traveling. So you're able to start applying the same strategies in different areas. As long as, of course, the team piece again, right? Having the right people, having the investor focused agent, having the right property management, having the right accountants and attorneys.
Let me ask you a quick question about property managers. Both my daughters coincidentally went to college, and they've got degrees, and they're both property managers. One manages large upscale multifamilies. The other one manages for a single investor who has hundreds of properties. He has a lot of properties. And he's like you, as a mix of a lot of single family, commercial apartments, there's probably not much of anything he doesn't have. So two entirely different skill sets. And I know from watching them, they are excellent property managers. They would probably watch your money better than you watch your money, if that's possible. But that's not true for all property managers. So how do you vet your property manager to know that they're not going to spend your what should be your income, your rental income? Sure, there will be expenses, but they're not going to be sloppy with repairs and contractors and things like that.
Yeah, I mean, there's so much there, and good for your daughters
Yeah,
that they're
that's
doing
awesome.
a great job at it and caring. And that's
Mhm.
amazing because there's some amazing property managers and some that are not quite as detailed. We'll
Mhm.
say that. And honestly,
Mhm.
it's you as if I'm going to give anyone advice, it's you as the owner of the property. You need to make sure that you're still overseeing them somewhat, because typically most people won't care about your assets as much as you do, and just having systems in place where it's getting done, at least until the trust is there, and then maybe you can just have some monthly reports. But we definitely made the mistake of removing ourselves too quickly, going, okay, I don't have to do this anymore. Whew.
Mhm.
And almost relieved, and then realizing, oh, wait a second, now it became a mess because I was involved enough. I had too much trust in others, type of thing. So now we still do, whether it's us or, I mean, it's our team member now, but to oversee the property managers, ask them for reports, making sure that they're doing their due diligence. And as for finding them, asking them questions again. What's their interview process with the tenants? How do they screen them? How many employees do they have? Do they have more than one plumber in case the one plumber is for example, busy, and
Mhm.
you have something in emergency at one of the units. So just making sure that they're that they're well connected. We love, of course, using just being in the real estate world for years and years. We have a very large network that we've built throughout the years as well. So of course, using some of our connections to help build that team as well.
Yeah, that's great. That's great advice because I know this is a tricky situation. And I think my take on single family homes from a property management perspective is you need to manage your first 8 or 10 at least for a time and learn how property management should be done, because when you're dealing with single family homes, they're pretty simple if they're in your own backyard, but how can you even know what the property manager should be doing if you've not done the job at all yourself? So I know that you all invest in many different places and you have a lot of assets, so you very quickly have to get out of that. But I do believe that you have to know how any job should be done. You don't have to do all the jobs, but if you just blindly trust people, that's when you get into trouble.
And I love that Mel and I, and you're bang on, Sharon. I love that Mel and I, we self-managed till we had 76, I believe, 76
Way too
units.
many. Don't recommend that for
So
one.
we
Yeah.
had 3 jobs, right, each, and 3 kids, and we were managing 76
Mhm.
units. So it became not fun. We wanted to stop buying.
Mhm.
So it waited too long. But looking back in hindsight, which is always 2020, I'm so happy that we did that because
Yeah.
now I know we know what it's like to be on call at night and on weekends, and when there's a fire or a flood or the roof,
Mhm.
there's a hole in the roof, or right there's snow and ice, and like anything that could happen has happened. So when a property manager tells us about it, it's like, okay, well, what did you do? What were your next steps? Did you contact,
Mhm.
like, we're already asking them the question. So I agree. Experience, you can't
Mhm.
beat it. And it's trust. Again, you have to have trust in your
Mhm.
PMs
You
and
have
your
to
team. Trust, but verify.
trust but verify. And kudos to you for managing that many. It's always been my stand that you just simply cannot know how things should be done with property if you don't have some experience in that yourself. Nothing replaces firsthand experience, but you got really a lot of it there, Dave.
Well, and I think as well, like if you don't have experience, I think that's okay, but you have to have the knowledge. I
Mhm.
don't know how to do everything that so many people do inside my business, the ins and out of it, but I have the enough understanding and knowledge to
Right.
kind of check mark everything as well. So if, for example, a new investor, you're living in a market where you can't cash flow, it's really hard to cash flow. You want to invest where returns are best. I think that's fantastic. However, you need to make sure that you have proper training on what to expect from a property manager and what to do when something goes wrong and things to look out for. And do you just go by the lowest interest rate, for example, or is there other bigger picture? Of course, it's a bigger picture. If you're trying to get the lowest price possible, well, you might get you may or may not get the quality that you're after as well. And there's things to look out for. What about last month's rent collection? Is there a fee for that? And there's a lot of things. So if you haven't had the physical experience of doing it yourself, definitely make sure that you have the proper training.
Exactly. That's such a good point, because as you scale, you really can't have done everything. You have to have that trust, but you do have to understand the process and know that. So I want to circle back just a second to a common mistake. It's around I think it's kind of a mindset that people get, a lot of investors get, when they start scaling up, they start seeing some success, and immediately their lifestyle goes up. They're taking their rent money and they've bought a big car, or they've bought a big house, and everybody thinks they're successful, but they're really maybe heavily in debt. So how do you manage your expectations, your wants versus your needs, and that whole thing, so that you don't scale up your whole spending pattern as you start to get this rental income in?
Yeah, and that is something we made a lot of mistakes throughout the years. That's something that we did well, was not overspend from the beginning. In fact, when we first met, I had just purchased a brand new vehicle. I was really excited. And we decided to continue to do this. And then we ended up selling it and driving this old rusty van that would squeal every time we'd started. And, we lived in my 2-bedroom apartment when I was 6 months pregnant. So we just slowly build. We were very frugal because we knew that we were trying to save money. Of course, we want to make sure that we can qualify for these mortgages as well. And then as we grew, we just had goals. So for example, I knew that, okay, if I'm going to be making X amount a month from this next triplex that I'm going to be buying, that will pay for my cleaner, which, might be a fifth of what I'm making, if that, the net profit. So I wouldn't spend all that money. Maybe it was just that a little bit. And then maybe once I buy another 5 properties and I get this much cash flow, I'll give myself an allowance to buy my next vehicle finally that I want. So it was just very strategically spending, and definitely not over budgeting. Don't buy a boat on your first refi. Go buy 25 buildings, and once you get there, then you can buy the boat.
Yeah,
so
let the buildings buy
exactly. So let the buildings buy your luxuries, but not overnight, right? Give yourself some time and prioritize as well. What do you want more? Do you want the boat? Do you want the car? Do you want to quit your job? Do you want to travel with the kids? All those kind of things. Have a budget, and then leave a lot of room, because sometimes things will happen where you need a new roof, or you have an unexpected maybe tenant that doesn't pay, right? You want to make sure that you have a backup plan as well.
I love that, because that is a common mistake, but that is truly the way you grow your wealth. And I have another friend in Chicago, and he never spends the rental income. He's now, he uses it to buy more properties, and he is a 6-figure net cash flow every month, and he still has the property buying addiction, but he can do that. So I wanted to kind of wrap this up today. I know from listening and learning about you all, that you all were in an accident, and it made you rethink your life. It made you rethink what would have happened if you didn't make it. What would the legacy be for your kids if you weren't there? So I want to end this we're not going to say on a down note, but I think this is such an important part of your story. I did want to touch on that.
Yeah, and for those who don't know our story, we were on our way to a real estate investing conference, and we were in a horrific car crash where passengers in the back seat and a careless transport driver hit a vehicle that hit us. We hit the guardrail. We rolled 4 times across the highway. We landed upside down, and it was the scariest times of our moment of our lives. Thinking that we're dying, never going to see my kids again. But it was also in a weird way, one of the best moments of my life, although, despite how scary it was, because we did survive. And then it just made us realize that we can do so much more with our lives. And that we're doing it all wrong. Like, I never would have been on a podcast ever before. I was barely on social media. I did not want to share or teach anyone how to do this as well. I had the scarcity mindset, didn't want to share it with anyone. And after the car crash and realizing like, wow, like, why are we not helping? Because I was able to quit my full-time job after the car crash. I was off with a severe concussion, and I had a lot of anxiety about going back to work. And Dave said, don't go back. I'm like, oh. And because we had real estate, I had the freedom in that moment to not go back. And it gave me the freedom of choice, because I had real estate back then. And then we thought, why are we not helping other people do this as well? And that's when we started the Action Family Mentoring Program. And now we've helped over 1,800 students. And now we're on a mission to continue to change as many lives as possible, because there's nothing special or unique about Dave and I.
Nope.
We're a regular couple with kids and all that. But we had a strong mindset, and we took a lot of action. We learned along the way, and we decided to do this. So that's essentially kind of what happened. That's our journey since. So since then, we're continuing to grow the Action Family Program. We're continuing to grow our portfolio as well, and really building that. It's all built around time freedom, location freedom, financial freedom.
It's such an inspiring story. Dave, do you have any final tips for people that you might want to add?
I just want to talk about what you said earlier, Sharon. You said you need to communicate with people, and that it made me think about it again, the property management side. So when you're finding deals, you need to communicate with people. When you have investors and lenders, you need to communicate with people. When you have tenants, you need to communicate with them. Property managers, communication is really key. So if it's something that you can take away from this is learn to really chat with people and be open. And yeah, communication is people have what you want, right? So learning to communicate with them is going to be key to your success.
Well, I'm certainly rooting for you. I think you've got a great program. This has been so much fun. So thanks so much for coming out today. What's the best way for folks to get in touch with you?
Yeah, so Dave and I were all over social media. So we're on Instagram and TikTok and YouTube and Facebook and Threads and all the platforms. And it's always Investor Mel Dave. So if you reach out to us there, we can definitely give you some additional information or a free mastermind or a free masterclass on actual deals that you can review and put this together a little bit better for you.
Okay, and guys, I'll put all of their links in the show notes so that you have them. So it's easy for you to get in touch with them. So thanks again, Mel and Dave, and thanks to all the listeners for coming out week after week. I do really appreciate it. And if you love this show, please share the show and leave us a rating and a review on iTunes. And I know you love this show. It helps people to find us, and I do appreciate it. So I will see you same time, same place next week. Bye for now.